Well, good morning, Tatiana. Welcome to Risky Scientists.
Thank you for having me.
Well, thank you for being here, Tatiana. We're going to talk about financial risks, which is not, I'm not going to consider myself an expert on financial risk. So, I'm going to begin by asking you to explain how you got into financial risk.
Sure. I've been in the wealth advising space. It was my only career since my college days. And I guess that comes with that, right? Risk and reward. It's the world that we live in. Although it had evolved over time, perhaps, and I have stepped into another layer of risk of what does it look like when you're going from the intact family to a family that's living on one perhaps income or lack of, right? So that's another risk on top of risk. So I'm sort of a risk juggler at this point, you'd say.
Yeah. I would think about those as compound risks, right? You're risking all sorts of emotional things, and you're already risking of financial things um, in breaking up a romantic relationship, and then there are compound risks from that. I'm eager to learn how you think about that particular area of risk. Um, just explain to us how you think financial risks are changing.
Right. Well, I think there is this different perspective, I think right now of technology, how the markets are evolving, right? There's a difference between the noise and a signal, right? A lot of times what we're experiencing is a lot of noise, right? The volatility is a lot of it is emotional. So behavior finance is real. And part of working with financial advisor, wealth advisor is to get that coaching in the way, right? Getting through that volatility and the risks factors to understand where there is a noise and there is a signal to, take certain action or perhaps none, right? Or maybe opposite, not to talk also on off the ledge from taking that action. And I think also its ability to understand it's not about security, right? It's about risk is really there. It's always there. And it's not about predicting versus what kind of risks are coming your way, but it's about understanding them and, building the confidence to navigate those risks. So I think we need to recognize what we can control and we cannot and build our confidence around it. That makes sense.
How do you think about more instrumental forms of financial risk? A lot of the audience will be aware that there's been a long-term trend change in the security of employment. We've shifted from a practice of long-term employment over years before people change jobs normatively to much quicker changes of jobs. And we're actually speaking in 2025, where the job market is extremely um, volatile. Let's put it like that. Um, and then there are in America various ways of that the federal government is using to try to encourage people to hedge against financial risks, such as through IRAs, which I remark on particularly to my European audience, where these are privileged instruments compared to what are available to Europeans. So,
Are they? Are they? That's also an expert view. You cannot look at it as silo and
yeah,
understand
well,
the complete picture, if that even makes sense.
yeah. Well, you explain that to us. Yeah,
Yeah. Well, I think if I put myself in a perspective of reader of listeners of your podcast and your channel, I would think, what would someone want to learn from me today, given my background of finance and divorce, right? What can I bring to the table? Not just addressing what risks are, but what can we do about them to mitigate them, right? So I would say financial industry is evolving in many directions. We definitely see this big shift. I think a lot of let's like unpack this a little bit. A lot of Wall Street is not as what it used to be stock picking. Technology and information has made it very efficient. There are different theories that are coming in, modern portfolio theory is one of we as our firm, Forum Financial, fundamentally believe in. We also sort of more of active investors with that passive, background and efficiency in technology and fees and the structure and in diversification. So if you look at a lot of the managers in the Wall Street, perhaps, and you look at the tenure of a lot of these teams, they're getting quite old, right? So what we have is we have this intellect changing, but the technology and AI is superseding that, right? So the numbers where they are calculated and they analyze are becoming more and more driven by the technology and then the levels we've never seen before. And at the same time, we have people who have really driven most of the decision making in Wall Street are getting older and they really are sort of, retiring in their space. So I think you're going to see this fundamentally not only changing people's life, but also how their NASDAQ is being handled and the evolution of what the future investments will look like. Right? I'm not an analyst. And I don't know enough to make the intelligent opinion on like what the future will look like, but I see the trends, and that's what I'm highlighting here. And then part of this, we also seen a lot of infrastructure change, and clearly political unrest is really creating another level of uncertainty. So we probably seen things before we've never seen, right? And then what do you do about that? Well, I think that's where the behavior finance is very important to understand kind of like what is again is just a noise and what is the signal, right? There's some things are there and in place and they worked for so many years, they're still working. And we need to remind ourselves of that, right? So for example, diversification is very important, right? We don't know, we don't have a crystal ball what's gonna really work or not. And you can't forecast on forecast. Like if you're gonna say, oh, well, we think the interest rates are gonna go up, we're gonna forecast that we're gonna do that. So what are you essentially doing, right? You're risking on a risk. So that's called forecasting on forecasting. People who believe in fundamentals and the math and logic behind it don't really make those decisions because they're not logical, right? So let's stick to what we know, what we can control. So that's in the way for me working with a professional and the discipline of that, right? To not make those rush decisions and really rely on the infrastructure and the relationship you've built with the advisor to get you through this other, volatility period. Like, right, you've been with me through some ups and downs and we've gotten through it. We'll get through this as well, right? It's just a matter of making the logical decisions and really seeing things for what they are, and not from what our imagination makes us sort of blow up in our head to be. That makes sense.
Yeah. So let me pick up on something that's implicit in what you're saying and is attracting a lot of lay person attention. There's concerns that the job market is trending towards more self-employment and part-time employment. The gig economy, particularly in Europe, is shifting people towards on-demand jobs such as deliveries. And AI is shifting employment to a more self-employed, contractually based employment model. So implicit in that is that more of us have to take more responsibility for our own finances. Do you buy that argument?
Why would we? Why is this as a result makes us take more responsibility of finances? Because we have to fall back on something because there's so much uncertainty in that. Is that what you're trying to say?
No, if people are not full-time employed and they no longer have access to the sort of employer-based pension schemes that their parents got used to, that we have to be more responsible as individuals
With
for
our investment, right?
our financial investments, at least.
Well, that's actually a good question. So, well, actually ties into what I do as a, life-changing divorce. That's really called maybe what is the true risk tolerance, right? The risk tolerance of a married couple who both have a steady employment, not in that type of environment that you just described, versus when you get divorced and you still might be employed, but now you have responsibility of caring for children and then the spouse that maybe never worked, right? Your risk tolerance automatically goes down because you are, you're also producing for children. Or if you're a wife who are, never had any type of income and gets this nest egg, when she could have been a lot more growthy before, now she becomes more like risk averse and more on towards like the balance, the income sort of side of portfolios. So is for an individuals that are, I think, in that space where their job could be gone tomorrow. But here's the thing though, I think we should always have this concept of financial independence as a premise and the flashlight and light. So every time we're building the portfolio or our nest egg, we need to be mindful, what is the financial independence that I'm going through, right? And what are the rocks and the pebbles in that story, right? The rock is the job and the employment. That's the income source that we build our portfolio. That's what allows us to accumulate and be financial independence and have a financial independence in some way. You also have to understand the elasticity of yourself, like how are you, what age you are, right? Could you change the trajectory of your potential, the income earning, right, trajectory? Can you modify your ways in the way that you can live humbly, or maybe adjust your professional space to something that be more, resilient and do something different? So that also going to be a more of a different type of questions to understand your risk tolerance, right? Because if you're 65, if you only knew what you did all your life and you have no other skill, you're going to be super risk averse. But if you meet a 65 private equity person who's made like, water out of the rock 33 times already in his life, and he'll do it again, then he has a different trajectory, although it's a little bit shorter now, right? So it's really more understanding yourself. If that's the really truly question to sit with yourself, and for professional really to mirror that back to you to see, okay, well, this is what you are, and this is what you telling me you are. Is this correct? Really truly understand your client and then work with them and with their financials, building towards that future based on now knowing the background intimately of that individual. I think that really is going to be more not a quantitative approach, but really qualitative approach. And I think that's where I think it is changing regardless the advisor space in that way. It's not about stock picking, it's not about returns, it's really more knowing your client, intimately. And that's really where I think we bring a lot of value. And um, it's been, I believe there's a study Vanguard has done of what alpha, that extra return the advisor brings in the relationship by having the discipline, by knowing their client well, by actually keeping the client accountable to the decision making that they first, decided to be about, and understanding the lay of the land of the finance.
Thank you. So let's get to your particular expertise. So can you summarize some of the risks from marital breakdown that perhaps wouldn't be obvious?
Well, I think the first risk will be in maintaining the liquidity, right? If you are divorcing and depending on what type of assets that our clients are taking with them, and also that's where I bring value because I think a lot of legal professionals just not trained to recognize and see that as well. Liquidity is a big issue, especially with the homes in the market that we have right now. Real estate brings a lot of that um, issues, I would say, and also the emotional aspect of individuals holding on to the homes that they really can't afford, right? So that's the first risk, that you will have an asset that's not accumulating but decumulating your future. And then second is really reevaluating your risk tolerance, because you are not going to be the same as what you were in an intact family. And really creating that financial plan path forward as to what is going to now look like. And it could be looked at very positively. Right now, you are organizing your life. And in fact, I see a lot of people paying attention to their finances all of a sudden because of that life-changing event. They are a pretty hot mess, then they come to me and then they become completely different. over, getting like a facelift with what we can, with what we're getting from this divorce, and really then focusing on what you can control. Now that's your nest egg and you're building it. And I think the unemployment, right, ability to be employed, again, that's a big risk for women who have been stay-at-home moms for a long time in their career, are just maybe blossom at some point, and it wasn't something that they wanted to do for various reasons. They took quite a bit of time off, and then they really never went back. So ability to earn, that's a very big aha moment, and it's very rare you can really salvage that unless person has a lot of belief in themselves and they empowered. And I've seen some women starting their own businesses and flourish, completely go in different direction. And it's actually a chance to maybe be someone you always wanted to be, but you went to school for something else you maybe didn't enjoy. That could be something you can start in your second chapter and be empowered and really drive the business that you always wanted to open. But also, it has to be realistic, right? If you are not getting alimony checks and you still have to bring bread to the kids, like what do you do with that? So the employment ability to be employable is a very big risk. And the ability to grow your accounts and contribute, because sometimes it's just enough to put lights and the bread in their home, right? When you lived on one income and you raised the family sometimes, and I'm talking about more like if there is a one earner, if they're female and male, that was breadwinner, and now they have to still support two families on one income. I mean, essentially, I think I can say that, but divorce isn't really divorce. You're not going away anywhere, especially if you have children. You're still going to have those two families. You're still going to have these kids. You just make it a lot difficult. Now you have to support everyone and also deal with the emotional aspect of that, right? So I think just understanding really the lay of the land and reality of that, um, and the big risk, if we're talking about not just quantitative, but qualitative, is the relationship with your children. You're really risking to lose that, especially I've seen a lot of it in the teenager cases when, a busy spouse has been building career and hasn't spent that much time and didn't build a strong relationship with children. A lot of times they see the consequences in the post-divorce with that. So that is to me, is very important risk. And that's something people underestimate going into it, especially when they have older children that don't want to split, their time between two homes. And it's very unfortunate, but that's really, really big risk and a side effect of divorce. And then just balancing your life after divorce. It's really understanding when are you going to be able to retire. It's not the same anymore. A lot of times if you're high earner and you shoot it for your mid 50s, you might have to work extra 10 years, right? So your expectations are going to be adjusted because you just lost half of your net worth. It went to another individual who is helped you to build that nest egg. That's how the law looks at that, in many states. So it's really reviewing your risks versus your liquidity needs and versus what is your risk tolerance at that point and addressing them, because they are going to be, like I say, divorce is already very uncertain time. I think layering all these other variables over that, it becomes super risky, uncertain in the way of the eye of that individual who's going through that life-changing moment. So it's a magnifying glass to a lot of that risk, in the way that the magnifying glass is your divorce.
Okay, so can you just explain to us how these risks are gendered? How do they differ for men and women?
Hmm. Um, well, reality is most women that do get even decent settlements and divorce don't do well. That's the numbers. That's actually the statistics. We can't avoid that. And that partly why is they are not well versed in money aspect. They don't have a relationship with money actually, and that's a huge risk. You're stepping in quite a bit of money that you've not your familiar territory. Absolutely right. So you're going from a 0 to 100 over a few months period, and that's women tend to be more. There's exceptions, but tend to be more on a woman's side. Where man, even if they have not particularly, worked with professional. They were around the money. They may be higher earners, and men are just tend to take risks better than women. They just go for it, and even if they don't know certain things, they kind of more confident in figuring it out. I think women, we just tend to feel like we need to know this much more and be so much more qualified to really, well, to pull the trigger and make a decision, right? So we are more risk averse because of that. Because we also, primary caretakers over our children. We are taking care of our parents. We are givers a lot of times. So I feel like we are like more risk averse, not because we cautious. It's just because we just have different realities than men do, right? And also health issues, a big one for a lot of individuals that are getting older, right? Their spending is changing. They're not traveling as much, but they're addressing a lot of it in healthcare. And women particularly, the menopause is real. It's been talked a lot about lately. And I think internalizing and being caretakers of many years has a price to pay, right? The the risk of cancer, any of these diseases that are as a result of the stress are much higher for women because we tend to internalize a lot and we carry a lot on our shoulders for the family. So I think the big probably differentiator would be we are more risk averse than men, and sometimes for a good reason. And I think I have two boys, so I have two teenagers. I know men very well, even though I'm a woman. I can see how certain things they just go and go for it, right? And where I would be like, I don't know about that. I'd think twice before doing that, but it's just how we are wired, right? It's that hunter-gatherer mentality versus a nurturer, right? That's something that it is genetics. You really can't avoid that. And that's kind of my humble opinion on that.
Thank you, Tatiana. So, right, so final question. What's your bottom line or your takeaway message that you want to give to the audience at the end here?
Well, I'm going to go back to that question where what can we do about our nest egg and like knowing that there's so much uncertainty. You should not wait to pay attention to your risks and especially money until crisis hits. You should always be living like it could happen to you tomorrow, but not like, you know, expectations are predisposition for disappointment, right? The happiness is the gap between what you expected and what you got, right? So the more you narrow this gap on a daily basis, right, you understand your reality and you can, when the difficulties come your way, you are facing them with like expectation. I knew this was going to come. It came a little sooner than I thought. That would be a very healthy mindset to move forward. So I would say building towards your financial independence has to have a clear plan, and it shouldn't be when all of a sudden the circumstances change. That's when I'm going to decide to really pay attention to my infrastructure. It really should be something that's a part of life. Like your not normal hygiene, that should be your hygiene of your own finances as well. So that's what I would leave you with.
Then, thank you, Tatiana.
You're welcome.